Hello and welcome to The Firm. On the show today, why SEBI wants promoters to sign relationship agreements with their companies. And Sahara's OFCD redemptions, confused or forced? Imagine Mukesh Ambani signing an agreement that determines his relationship with Reliance Industries, or Azim Premji signing a relationship agreement with Wipro. It sounds novel, doesn't it? Well, that's what SEBI is proposing. It recently issued a consultation paper on corporate governance, and that paper proposes significant changes to Clause 49 and other corporate governance measures. Now, in that paper, on page 30, Proposal 11.26, SEBI suggests laying down the fiduciary duty of controlling shareholders to the company and its minority shareholders. Controlling shareholders, promoters. Well, it also proposes a relationship agreement in that paper between the company and the controlling shareholder, specifying the duties and responsibilities of controlling shareholders. Now, this may be the first time that you've heard of relationship agreements, but the UK has already experimented with them. In fact, they were mandatory in the UK till 2004 and are now about to make a comeback. To understand whether relationship agreements will work in India, it would be useful to understand how they worked in the UK. And to do that, I spoke to Simon Wong, a visiting fellow at the LSE. Simon is also a partner at investment firm Governance for Owners, and Robin Ogle. He's partner at Slaughter & May, and Robin has done several India-focused deals, so he understands the business environment here fairly well. In 2003, Anil Agarwal, his family and his holding company Volcan entered a relationship agreement with Vedanta Resources before the company's UK listing. The agreement included autonomy to Vedanta, that any transactions between Vedanta, the Agarwal family and Volcan would be at arm's length, that at all times there would be a majority of independent directors on board, that Vedanta would follow principles of good governance, and so on. Up to 2004, all controlled companies wanting to list in the UK have to sign relationship agreements with their controlling shareholders.
They were very similar. Actually, you look at a lot of them, they say very similar things, and they're phrased in broad terms. They're principles about the typical contents would be requiring engagements between controlling shareholder and the company to be handled on an arm's length basis on normal commercial terms. There'd be broad statements about how the controller wouldn't use its influence to prevent the company from complying with its listing rule obligations. There'd typically be some sections which would deal with appointments to the board and how many independent directors there might be. There'd be a description of how many directors connected with the controller there could be. And depending quite on the business empire that the controller had, there might be some comments about, some sections about non-compete, so that the minority shareholders would know that the company would operate as a proper arm's length commercial enterprise and wouldn't be dependent on the business of the controller and wouldn't be subject to value extraction by the controller in favour of either itself or the rest of its empire.
It has continued, even though it was abolished as a requirement in 2004. Many companies, as a matter of best practice, did continue to enter into these agreements. It provided some comfort, but there's always the question of verification. But you also expected that the controlling shareholder would exert influence, continue to exert influence. The key issues certainly is with respect to related party transactions, and their minority shareholders feel a bit more vulnerable and would like to see sufficient protection.
It gave comfort to the market as a whole. And we got rid of them really because in that environment of those times, which were very different from where we are today, if you look at markets then, markets now, and the regulatory system we had then and what we're in now, they were got rid of as part of a deregulatory approach. So we went from strict rules-based regulation to much more of a principles-based regulation. New principles were being introduced which, taken together with disclosure, risk factors and the role of the investment bank in an IPO, were thought sufficient to give comfort to the market as a whole that the company would be run on an independent basis.
Last October, UK's FSA proposed bringing back relationship agreements. The discussion paper suggests that premium listed issuers with a controlling shareholder or one that holds 30% or more of the voting rights, would have to sign relationship agreements with their companies. The agreements would be similar to the pre-2004 ones, with an additional requirement that a controlling shareholder must not influence the day-to-day operations. The FSA has also proposed that all premium-listed controlled companies must have a board that consists of a majority of independent directors or an independent chairman. Only independent directors would approve material changes to a relationship agreement, and independent directors would be elected via a new dual voting process that gives independent shareholders more say. Lawyers say these proposals have been prompted by recent boardroom battles in companies with significant shareholders, such as UK-listed Indonesian resource company Bumi, that has witnessed a pitched battle between Nathan Rothschild, the owner of approximately 12% of Bumi, and the powerful Indonesian Bakri family that has a 47% stake.
There have been a few controversies where you see companies in the mining sector listed in London where there was an impression that the controlling shareholder was too dominant and perhaps imposed its will on the board. And coupled with that is the fact that these companies are on indices, and as a result, passive investors would be required to hold shares in them. So I think in that sense, there was a perception that shareholders are quite vulnerable and that additional protection would be needed.
The content requirements that the FSA is thinking about would be actually pretty similar, with one key distinction, which is that there's proposed to be a new rule about how the controller should not be able to interfere operationally, shouldn't be able actually to influence operationally the day-to-day conduct of the company. And that, I think, probably goes a step beyond where we have been so far.
There are other changes as well. As you may be aware, in addition to a relationship agreement, there's a proposal that companies with a controlling shareholder should have, for example, a majority of independent directors. So it should be looked as a suite of protective measures rather than just this. I would agree with you that perhaps in and of itself, the relationship agreement may not be doing that much more. And if anything, I actually have a concern with respect to the new provision, which Robin pointed out, about controlling shareholders not or committing not to be involved in day-to-day operations. And you would imagine that in some companies, for example, a successful tech company where the founder is still involved, you would expect that sort of guidance and involvement.
But why do you need a relationship agreement to determine a strong board or a board independent in character? Let me contrast this a little bit with what's gone on in India, right? For instance, we have separate measures that require listed companies to have a minimum number of independent directors on board, depending on whether the chairman is an executive or a non-executive chairman. These things can be done outside a relationship agreement. There can be enough rules, regulations, and laws that monitor and sort of supervise how related party transactions are done. Taxation looks at this as well. So I'm just trying to understand whether a relationship agreement does things that other laws, rules, and regulations don't. Can they offer safeguards that can't otherwise be provided in a system? Or are they just an agreement that makes everybody feel better but doesn't really achieve much?
I think there are some interesting features of relationship agreements, such as when the controlling shareholder pledges to refrain from exercise his or her full influence. So, for example, saying that, the directors that I appoint will not decide on any sort of related party transactions, or that I will limit the percentage my shares will carry in a shareholders meeting vote. So I think those are actually interesting features that could provide comfort, and that they're not specified in the current proposal.
Inspired by the UK, India's securities market regulator SEBI has also proposed to lay down specific fiduciary responsibilities of controlling shareholders and consider the feasibility of mandating relationship agreements in India. The regulator explains this move by saying, there have been instances where the controlling shareholders have used the company to steer their personal interests, sacrificing the overall interest of the company, mostly through abusive related party transactions. The consultation paper also has proposals to curb such abusive RPTs by requiring the approval of a majority of the minority shareholders. In fact, SEBI has introduced similar safeguards recently in its regulations on schemes of arrangement. These actions combined point to a reining in of the majority. The question is, will that work in India?
I think it'll be quite a challenge. One of the things you buy, of course, when you're buying into a company with a promoter is you're buying the skills of that promoter. So there is a tension between buying into a key individual and saying, actually, I want the company to be run completely independently as if there wasn't one. And I think you need to achieve that balance. Disclosure is obviously important, but to guard against abuse, it will be useful, I think, to have some measures which give comfort to the independent shareholders that their interests are going to be protected.
I just think that it's probably unrealistic because, as Robin and you mentioned, they are often the driving force, the driving engine behind the company. And what's interesting is you're seeing developments globally where countries such as Brazil, for example, who are starting to see companies now with some dispersed share ownership, are starting to say, wait a second, maybe we want a stronger owner because we think they're committed, they think longer term, etc. So I think there's an interesting debate going on globally. What you're concerned about is not necessarily the influence of the controlling shareholder, but the abuse of that power vis-a-vis the minorities. And I think in that sense, maybe protections that provide greater comfort to minority shareholders, for example, just stronger rights for them to approve related party transactions, more frequent disclosure, immediate disclosure of material related party transactions, or even one or two seats that they will occupy themselves or they will nominate directors to those seats could provide more effective protections.
I have no doubt that none of these proposals are going to go down well in India. Our promoter culture brooks no interference, but SEBI seems determined to at least get all stakeholders to rethink how good governance ought to be approached. And luckily for SEBI, the tide in many countries is turning against big business and dominant shareholders. Well, we'll be watching what happens to this governance paper very closely, but for now, let's take a quick break. On the other side, Sahara's OFCD redemptions, confused or forced?